Hi, Dan Whittaker here with the Advisor Resource Center to talk to you today about accounting for leases. Lease accounting is something that services with many businesses. GAAP requires leases to be classified as either a capital lease or an operating lease. A capital lease is a lease that transfers substantially all of the benefits and risk of ownership to the lessee. From an accounting perspective, the asset is capitalized on the balance sheet and depreciated over the useful life of the asset. The corresponding debt is recorded as a liability at the time that the lessee receives the asset. Payments are recorded as principal and interest as if it were a normally amortized loan. To qualify as a capital lease, at least one of the following four criteria must be met. 1. Ownership must be transferred at the end of the lease. 2. A bargain purchase option test, similar to the ownership transfer test. However, there is typically a clause like a $1 buyout or a clause that allows the lessee to buy the asset at a price substantially below the expected fair market value. Third, the 75% test. The 75% test is met if the lease term is at least 75% of the estimated economic life of the leased property at the time the lease is entered into. Fourth, the 90% test. The 90% test is met if the present value at the beginning of the lease term of the minimum lease payments is at least 90% of the property's fair value to the lessor at the inception of the lease. Next are operating leases. Operating leases are simply those leases that are not classified as capital leases. From an accounting perspective, they are treated as rentals, and any amounts paid are expensed in the current period on the books of the lessee. Please visit our Advisor Resource Center, where we have provided a white paper and lease classification flowchart that supports this video.